Today, non-banks get a leg up. Hello again, I'm Martin North, the Principal Analyst at Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Another month, more finance data, and the lowest monthly housing print since data started in 1976, as July 1984 looks like a data blip. So we must look at the data once again, but also zero in on the non-banks, who are growing their lending books at around 17% per annum for owner-occupied loans. As the banks tighten their controls, people are looking for an alternative path. So strong the property religion is, and regulators are way off the case. This is also, by the way, what happened in the US in 2006 onwards, ahead of the global financial crisis. So perhaps we are following that path. And by the way, if you value the content we produce, please do consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or consider joining our Patreon program. Again, here is the link. We really appreciate your support to help us to continue to make great content. The links are also in the comments below. APRA released the monthly banking statistics to the end of January 2019, and they show a further moderation in home finance lending to both owner-occupiers and investors. In fact, investment lending balances fell a little. Now, it's worth highlighting that these are raw numbers, there's no seasonal adjustment, and are based on the returns sent by the banks, and possibly data is late thanks to the holidays, and of course this is before any of the recent loosening has been announced. Nevertheless, it appears to show that the credit impulse continues to slow, and this will translate into further home price falls ahead. Overall, the value of home lending from the banks rose 0.15% in the month to $1.67 trillion, and this is equivalent to just an annual rate of 1.8%. This is the lowest growth rate for years. Within that, lending for owner-occupation rose by 0.27% to $1.11 trillion, and lending for investment purposes fell 0.09% to $557 billion. Investment loans comprise 33.37% of all loans on book. We can track the growth rates by category. Overall growth rates continue to fall across the board. The individual movements within the banks also makes interesting reading, with all of the large banks seeing their investment lending pools shrinking, while Macquarie, HSBC and Bendigo Adelaide Bank plus AMP are taking up the slack. We hope that they have adequate underwriting standards in place. The portfolio movements remain pretty much the same, with CBA the largest owner-occupied lender and Westpac the largest investment loan lender. And while the 10% APRA speed limit on investment loans is now obsolete, the annual movements show that the majors are well off the pace compared with some of the smaller lenders, and the market grew, based on monthly averages, by just 0.73%, with below zero growth rates in 4 of the past 12 months. The investment lending party is well and truly over, but the hangover in terms of big loans, interest-only loans and falling returns will be with us for years. The credit impulse is dying, and home prices will continue to fall as lending standards are normalised. Let's be clear, freely available credit inflates home prices, and the reverse is also true. Short of breaking the responsible lending rules again, there is no way out. And the RBA released their credit aggregates to the end of January 2019 today, and the data confirms that lending growth continues to slow across home lending and personal credit. We'll get to the details shortly, but I first wanted to head to a comparison between the APRA data for the banks, also released today as we discussed, and the total credit from the RBA. The gap between the two relates to the non-bank sector, and the fact is, despite all the funnies in the numbers, lending from the non-bank credit sector is booming. Owner-occupied non-bank lending is growing at an annualised rate of 17.2%, and lending from investment housing is at 4%, both well above the bank sector. This is unsurprising, given the different funding arrangements and restrictions between the banks and non-banks. Of course, both have responsible lending obligations, but evidence suggests that the non-banks are more willing to lend at a price. APRA sort of has responsibility for the non-bank sector, but do not seem to be doing much to stem the tide. Meanwhile, the RBA lending aggregate shows that annual Owner-occupied home lending now stands at 6.2%, and investment lending is at 1%, and overall credit growth is at 4.4%. There was a considerable drop-off in personal credit and a rise in business lending. The monthly trends are, of course, more noisy, as expected, but also show similar falls. Turning to the credit stock and using the seasonally adjusted figures, we see that overall credit still advanced. Total loans for own occupation rose by $4 billion to $1.22 trillion, up 0.33%, while loans for investment purposes rose $0.3 billion, seasonally adjusted, to $594.6 billion, up just 0.04%. Investment loans were 32.8% of the total, down slightly from last month. And business credit rose by $3.1 billion to $956 billion, up 0.33%, and comprised 32.8% of all lending, up just a little from last month. And personal credit fell by $0.9 billion to $147.5 billion, down 1.15%. And it's also worth noting the seasonally adjusted figures overstates the investment lending by a net $0.6 billion. And remember that the RBA use the seasonally adjusted numbers when they come up with their monthly and annual growth statistics. So to me, the slowing credit impulse is clear, as is the worrying rise in non-bank lending. Adopt the brace position. If you liked what you saw here today, please like the post and add a comment or question. I read them all, and share it via your social media channels. If you have not yet subscribed, please ring that subscribe bell to receive alerts for future posts. And if you've already subscribed, thanks, I really appreciate your support. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.